Hello everyone, this is Mark with Semantics Trading with your daily report. So we do have a very heavy event risk this week with FOMC and rate decision, big tech earnings, core PCE, and other events. And it's not a type of situation where you can go position yourself very heavy, as there are so many different events that it's important to be very nimble and mindful of this. And I think it's very important to play very defensive and preserve capital, as you would rather want to be very light going into all these different types of data that is coming out. If we take a look here, we did see that there's a high amount of short interest stocks covered in large quantities last week, about 2.3 sigma over the past 5 weeks. And we do have the Morgan Stanley strategic content team noting that this was the second largest week of active degrossing this year, and many US long-short funds have actually ended to be net buyers of equities after covering the shorts in excess of what was sold on the long side. And as a result of this dynamic, the US long-short net leverage has ended the last week at the highest point since May, but it is still far from historical levels. And according to Spot Gamma, we saw that the short gamma dealers were forced to chase the rally last week, as they have become shorter deltas on the squeeze higher. We also saw that Walmart came out today with lowered guidance, citing excess inventory. And this is due to the bullwhip effect that I have highlighted in previous videos and reports, and this can be seen in the surge in the inventory to sales ratio, which is basically a measurement by the amount of inventory a retail company holds versus sales. And with their supply chain completely disrupted, and with a myriad of other issues, it is likely we will have several quarters of issues with retailers, as it's not quite an easy thing to gauge inventory for the retailers. And strangely enough, a lot of these companies had assumed that people would have kept spending at these high levels, very similar to the pandemic, and that this amount of spending during levels that were maintained during the pandemic would continue on, and they clearly overestimated this expectation. And it appears that the inventory and also exports are the main causes of the drag on GDP as well. So that's very important to keep in mind. And very interestingly enough, on GDP, we do see the consensus on GDP being mildly positive, which is quite interesting, which I'll talk about a bit later. If you look at sector performance today, we did see that we have commodities like natural gas bid a bit higher, and as a result, energy outperformed the market, and risk sectors sold off today and ahead of key events. Utilities did perform pretty well as due to the energy sector outperforming today, and financials and healthcare and industrials were also bid on the day. We do see that the market is also discounting 75 basis points this rate decision, and we do have also 25 basis points being priced in for the following rate hikes this year. And also in 2023, if you look at the Euro-Dollar futures curve, we do have 3 rate cuts priced in. And if the GDP does, so going to the GDP this Thursday, if GDP comes in consensus, then it will make the rate cuts less probable, as if it comes in strong, then it gives the Fed more room to be aggressive potentially, and as a result, you may see the yield curve invert further, and the short end of the curve will move up, and you'll see inflation and growth premiums get sucked out of the long end. Hence, that would make the yield curve more inverted. But if we do see the GDP number being negative, then future expectations of growth moves up as the rate cuts in 2023 becomes more likely, and we will likely see a steepening of the yield curve, and that in turn will be more positive for long duration and tech and growth as a result. And with that being said, that is it for today's report. I want to thank you all for watching. And if you did like the video, be sure to subscribe and like the video, and as well as follow us on Twitter. We do have a Discord if anyone is interested in joining. But anyways, thanks again. This is Mark signing out.